Ever stared at a massive financial prospectus and just totally glazed over? Yeah, you are definitely not alone. The sheer wall of text, the endless jargon, it's a lot. But today, we're taking a dense scheme information document and transforming it into clear, easy-to-digest insights. In this explainer, we're going to unpack a very specific, fascinating investment vehicle from SBI Mutual Fund. So let's kick things off with a massive question that sits right at the heart of momentum investing. When you're relentlessly chasing growth, how do you mathematically capture a market that is actively on the move? Like, how do you systematically buy into what's already going up instead of just guessing what might go up tomorrow? Well, that exact concept is the foundational idea we're going to explore today. To make sense of all this, here is our roadmap. We'll start with chasing long-term growth, then deconstructing the fund name, looking at the engine of momentum, understanding the FOS structure, and finally weighing the very high risk. Let's dive into Section 1, Chasing Long-Term Growth, the core objective. Before we get completely lost in the mechanical weeds here, we really need to focus on what this fund actually wants to achieve for you. What is the point? Well, the explicit goal of the scheme, straight from the source document, is long-term capital appreciation. That is this fund's absolute North Star. It is not trying to generate a steady monthly income, and it is definitely not a safe defensive harbor to just park your cash. It is explicitly designed to aggressively grow your capital over a long horizon. But honestly, the specific method it uses to chase that growth is what makes the whole thing so incredibly interesting. Moving right along to Section 2, Deconstructing the Fund Name, Unparking the Jargon. The official scheme name itself is actually a literal roadmap to its strategy. I mean, SBI Nifty Midcap 150 Momentum 50 ETF FOF sounds like a total mouthful, right? But every single piece of that crazy long name represents a strict rule the fund has to follow. Let's break those rules down, starting with the actual universe of stocks it's allowed to play in. First up, the fund strictly restricts its universe to the Nifty Midcap 150 index. That means it completely ignores those massive, slow-moving blue-chip companies, and it entirely filters out tiny, unpredictable microcap startups. It focuses 100% on the top 150 mid-sized companies in the market. And to even be considered for the club, a stock has to have at least a one-year listing history. Plus, any highly volatile stocks that constantly hit their trading limits, they are tossed right out. This creates a solid baseline pool of established but still rapidly growing companies. Which brings us to Section 3, the engine of momentum, selecting the top 50. Okay, here is where it gets really interesting. How does the fund narrow those 150 mid-cap stocks down to an elite 50? It does it entirely through a ruthless mathematical process. The index methodology acts like a dedicated high-performance growth engine. It calculates what's called a normalized momentum score for every single eligible stock, based purely on its 6-month and 12-month price returns, and it adjusts for volatility. So it is literally hunting for the stocks that are rising the fastest and the smoothest. It coldly ranks them all and skims only the top 50. No human emotion, just pure data. And when you apply that math, you get actual constituents like 197 Communications and a Ditcher Barrel to Capital carrying significant weight in the portfolio. But wait, how do they decide the weight? It isn't just based on how big the company is. The weight is derived by multiplying that normalized momentum score we just talked about with its free float market cap, meaning the shares that are actually available for the public to trade. And if a stock starts to lose its momentum, it mathematically gets pushed right out the door during the semi-annual rebalancing. All right, Section 4, Understanding the FOF structure, a fund within a fund. This brings us to the FOF portion of that giant name. FOF stands for Fund of Funds. Instead of a manager sitting there buying shares of these 50 companies directly, this is essentially a matryoshka doll of investing. The scheme simply takes your money and uses 95 to 100% of it to buy units of an underlying exchange-traded fund, specifically the SBI Nifty Midcap 150 Momentum 50 ETF. It's basically a convenient wrapper designed to give you direct access to this complex strategy without you even needing to open a brokerage account. And because it's structured this way, accessing this incredibly aggressive growth strategy becomes surprisingly accessible for everyday investors. The minimum initial application amount on a continuous basis is just 5,000 rupees. Think about that. It brings a highly sophisticated, institutional-grade momentum strategy right down to a very approachable entry point. But, as always, there's a catch. That accessibility comes with a specific caveat you absolutely need to be aware of.
The source document clearly states there is a 1% exit load if you choose to redeem your units on or before 15 days from the date of allotment. Why? Because this rule is actively designed to discourage short-term day trading behavior. Remember our first point? This entire vehicle is expressly built for long-term capital appreciation.
Time for a reality check in Section 5, weighing the very high risk, the cost of growth. Now, we cannot honestly talk about a fund systematically chasing aggressive momentum growth without staring the risks right in the face. The official riskometers from the source document show both the underlying benchmark index and the scheme itself anchored squarely in the red, very high risk, period. When you chase rapid momentum in mid-sized companies, you are automatically accepting a significant level of volatility.
The sources outline some very specific vulnerabilities you take on here. First, because this is a fund of funds, its performance is completely 100% dependent on the underlying ETF. You also face all the inherent price risks of the equity market. But crucially, and you really need to hear this, as an investor in an FOF, you bear dual recurring expenses. You're paying the expense ratio of this fund plus the expense ratio of the underlying ETF it invests in. It is a built-in structural cost that you have to factor into your growth expectations.
Furthermore, the source explicitly warns about the double-edged sword of passive management. This fund is not actively managed by a human making real-time judgment calls. It strictly follows the math of the index methodology. That means if the overall market suddenly declines, or if one of those top 50 stocks starts plummeting on terrible news, there is no human hitting the panic button to sell it off and protect your capital. The fund will only remove that plunging stock when the formula mathematically pushes it out at the next rebalance. So you ride the mathematical wave up, but you also ride it straight down. Finally, Section 6. Conclusion. Aligning with your strategy. Ultimately, this scheme represents a very strict, incredibly transparent trade-off. On one hand, you get this systematic, emotionless engine designed specifically to identify and chase long-term growth by buying into trending mid-sized companies. On the other hand, that very same growth engine is structurally paired with very high inherent volatility, the burden of dual FOF expenses, and the rigid, unyielding rules of passive management during a market downturn. So knowing the strict mechanics of exactly how this fund targets its core growth goals, and knowing the structural costs required to fuel it, you have to ask yourself a tough question. Does this specific vehicle actually align with your long-term goals? And more importantly, do you actually have the stomach for the risk? Understanding the source material is the very first step to making that decision. Thanks for joining me on this explainer, and remember, always question what's really under the hood of your portfolio. See you next time.